Westfield faces an uphill battle to get its split of its domestic and international businesses over the line. To explain how that's going to work, I'm joined by Stephen Bartholomew from Business Spectator. Steve, how's this all going to play out?
So you've got Westfield Group,
Yep.
and then you've got Westfield Retail Trust.
Yep.
They each own basically half of their interest in the underlying shopping centre portfolios,
Yep.
which Westfield Group manages. And the proposal was that Westfield Group would merge all of its Australasian assets
Yep.
with Westfield Retail Trust to form a completely integrated Australasian confined portfolio.
Yep.
74.1% of the proxies voted for that proposal, but it needs 75% to get across the line.
Right.
And on the morning of the meeting, at the Westfield Group meeting, Frank Lowy said the board of that group had met the night before and resolved that if the scheme proposal was defeated, they would still go ahead with the spin out. So in effect, they'd spin out exactly an entity that looks exactly the same as Westfield Retail Trust, except that would also have the management rights to both its share of the properties and Westfield Retail Trusts.
Right.
So it'd look very similar, except all the management would be in the new entity, so it'd be a competing entity.
Right.
And that's the new information which caused Westfield Retail Trust directors to adjourn their meeting, saying they needed to give security holders time to digest it.
Yeah.
And it's, of course, been seen as a very coercive thing for Westfield Group to have done.
So what's this new meeting going to do then?
Well, if the adjourned meeting is reconvened, they'll have another vote. They'll be given some more information. The nature of the information will depend on what the court approves or doesn't. But fundamentally, there'll be a new set of arguments as to why Westfield Retail Trust security holders should vote for the proposal to merge their business with the Australasian assets of Westfield Group. Amongst the arguments will be, if they don't vote for it, this new entity, which Westfield Group would then spin out of its own volition, would be a competing entity to their own business, with a management overlay that they wouldn't have, and their assets would be managed by this new entity, which would have superior growth characteristics. Now, that may not convince some of the dissenting security holders to vote for it, given that a Unisuper, for instance, which is the biggest unit holder in the retail trust, is more interested in yield than in capital gain. So from its point of view, if it can buy Westfield Retail more cheaply, it gets a better yield. So there's some interesting kind of tensions to be resolved, and it's not clear that a new meeting would actually produce a different result. Now, of course, if the adjourned meeting isn't reconvened, if Westfield Retail Trust has to hold a brand new meeting, then circumstances could change quite a lot, because in the meantime, the units are trading. So we'll have a different set of owners at the margin to those who voted last week.
So they got 74.1% last time. It is 75%. So is Westfield lobbying furiously to institutional investors to try and get them over the line? Is that how the process is working?
The Westfield camp is lobbying anyone they can think of to try and get it across the line, trying to make better arguments, I've got to say, than they've made previously, and trying to make the case that allowing a competing entity to Westfield Retail Trust to enter the market is not going to be good for Westfield Trust unit holders, i.e., if you don't want that, then you better vote for the original proposal.
And what about the idea that if it was a different competing entity, that in fact the share price would it be less, or would it be more?
If there were two Westfield Retail Trust clones out there, one with the management overlay, the Westfield Group spin-out would have more leverage, right? So if you're a passive investor looking for low risk passive income, it'd be less attractive to you. However, it would have superior growth characteristics. And so if you wanted both yield and capital growth, and of course if it's got growth, then over time it should produce more income, right? So if you wanted a growth vehicle, that would be the one you'd go to. And it's also the one where the Lowies would own 8% of it, so you're closer to the controlling family, or the effective controlling family. And because it manages Westfield Retail, there's a concern, I would have thought, amongst Westfield Retail Trust security holders that their interests might be prejudiced if there is a competing vehicle out there.
Right, okay. And then in terms of the kind of the overarching Westfield Group, I should say, how does that sit them on the two kind of outcomes?
The strategy would remain intact regardless of which option was adopted, because the strategy fundamentally to separate the international businesses of Westfield from the Australasian businesses, because they have different growth characteristics and risk characteristics. The international business has got more growth potential, but it's much more development oriented, so there's a riskier flavour to it. However, it would also be better understood as a international business by American investors in particular. It looked much more like the businesses Westfield competes with offshore. The Australasian businesses are very high quality. I mean, this is the best and biggest portfolio of shopping centres in the region. It's nearly 50 centres, and they're all high quality. So it would be lower risk, more passive income, but with a little bit of a development tinge to it. So it'd be a very attractive group, be easily the most attractive Australasian property portfolio.
You talked about one of the alternatives being that you've got a higher growth version of the business here. I mean, is there really growth in Australia in terms of retail?
There has been. I mean, there's an argument that we're oversupplied with retail space. However, the Westfield space is premium space, and that seems to have not only held up a lot better than some of the second-tier properties, but actually grown better. So if you like retail properties, then that's the best group you can have.
Steve Bartholomew, thanks very much.
Thanks.